Welcome to today's video on the annuity trap. First, we will frame why immediate income guarantees can appear safe but potentially derail long-term financial health. Next, we will unpack how annuities work, what you really lock in when you annuitize immediately, and the massive opportunity cost many investors ignore. Finally, we will explore smarter ways to design income without sacrificing growth. Let's begin. To start, here is our roadmap. First, we will clarify the true purpose of annuities. We will analyze why buying an immediate payout annuity with a large lump sum can feel like guaranteed liquidation rather than growth. After that, we will quantify the trade-offs with numbers and visuals. Next, we will outline alternatives and a due diligence checklist. Finally, we will test your understanding with 2 short quizzes and wrap up with key takeaways. Before we dive in, a quick but crucial disclaimer. This content is for education only and does not constitute financial advice. You should consult a qualified fiduciary advisor who understands your full situation. Any returns, payout rates, or projections referenced are hypothetical, may not reflect future results, and will vary by contract, carrier, fee structure, riders, and state-specific rules. With that in place, let's continue. Next, let's ground ourselves in the basics. Annuities are first and foremost income products that help manage longevity risk. They can provide predictable cash flow. However, they are not primarily designed for market-like growth. Many buyers confuse the emotional relief of a steady check with actual investment returns. A 4% payout from an immediate annuity is not the same as earning a 4% investment return. It often includes returning your own principal. With that foundation, we can now analyze the immediate annuity trap. Now consider the immediate annuitization scenario. You take a large lump sum, such as a $400,000 pension buyout, and convert it into an immediate payout. Income begins almost right away. Because the payouts start early, the annuity has little time to grow or compound. In fact, early payments often outpace the annuity's minimal guaranteed interest, which effectively means you are receiving your own principal back. This can create the illusion of a steady yield while actually depleting the balance. Meanwhile, you may be missing out on market participation and compounding that could significantly grow the asset base over time. As a result, while the income may feel comforting, your long-term wealth trajectory and purchasing power can decline. With that in mind, let's quantify what is being sacrificed. Before moving to diagrams, let's do a quick sanity check. Assume a $400,000 lump sum and a 4% immediate payout. That produces $16,000 per year. However, understand that a 4% payout does not mean you are earning a 4% investment return. The payment is typically a mix of small interest credits and a larger return of your own principal, especially early on. This is why the account may feel like it is being liquidated slowly. With the math framed, let's visualize the decision path. In this flowchart, the starting point is a $400,000 lump sum. One branch shows buying an immediate payout annuity, which triggers payments right away, but leaves little time for compounding and can lead to principal depletion over time. The value proposition is guaranteed cash flow with reduced market risk. The alternative branch invests in a diversified portfolio, allows time for compounding, and later implements a sustainable withdrawal plan. This path accepts market volatility, but can lead to a potentially higher ending balance. The central insight is the opportunity cost of starting payouts too soon and locking into a contract that prioritizes cash flow at the expense of growth. This pie chart illustrates that early income checks from an immediate annuity are frequently composed largely of your own principal, with only a smaller slice representing credited interest. Because of that composition, the experience can feel like a guaranteed drawdown. Understanding this mix helps you interpret what the payout stream actually represents, especially in the early years. Now let's compare paths side by side. Here, we contrast an immediate annuity and a diversified portfolio. The immediate annuity delivers predictable income with minimal market exposure, but it also limits compounding and flexibility, and early payments often include returned principal. The diversified portfolio introduces volatility and sequence risk, yet it offers time for compounding, liquidity, and the potential for a higher terminal value if managed prudently. This comparison underscores the trade-off between certainty of cash flow and long-term growth potential. Next, we will look at a simple numbers table to make this more concrete. To illustrate, consider 2 simplified hypothetical paths over 15 years. In the immediate annuity example, a 4% payout on $400,000 produces $16,000 in year 1, roughly $240,000 over 15 years, and no remaining account balance, since it is an income contract. In the diversified portfolio example, assume an average 7% return and a roughly 4% withdrawal rate. The first-year withdrawal would also be $16,000. Total withdrawals could sum to around $295,000, and the ending balance might be approximately $620,000, acknowledging market variability. These figures are illustrative only, and not guaranteed. They highlight the opportunity cost of locking into immediate income versus allowing time for compounding. Now, let's move to due diligence you can apply before making decisions. Before committing, follow a disciplined checklist. First, demand complete transparency on all fees, riders, surrender schedules, and crediting terms. Second, clarify death benefits and liquidity restrictions. Third, ask for break-even timelines compared with balanced portfolio approaches. Fourth, model inflation and the erosion of purchasing power under flat income. Fifth, stress test portfolio alternatives for sequence risk. Sixth, verify insurer financial strength and your state guaranteed coverage limits. Seventh, compare buying a single premium immediate annuity now with deferring income through a deferred annuity or qualified longevity annuity contract, which can offer higher payouts later. Eighth, consider partial annuitization combined with a growth sleeve to maintain compounding. Ninth, insist on side-by-side illustrations built from the same assumptions so you can compare apples to apples. With the checklist in hand, let's explore alternatives. Alternatives include delaying annuitization to potentially secure higher future payout rates. You can build a treasury or certificate of deposit ladder to cover near-term spending while leaving a growth sleeve invested. A bucket strategy separates short-term, intermediate-term, and long-term assets to align time horizons and volatility. Partial annuitization can satisfy base income needs while enabling the rest of the portfolio to compound with flexible, dynamic withdrawals. Additionally, deferred income annuities or qualified longevity annuity contracts can be used later to protect against very old age income risk. To visualize timing, let's review a simple timeline. This timeline shows a staged approach. In years 0 through 3, a cash or treasury bill ladder funds spending needs. Throughout years 0 through 10, a growth sleeve remains invested to benefit from compounding. Around year 5, partial annuitization can be considered to secure a base of guaranteed income. Between years 7 and 10, a deferred income annuity or QLAC could be initiated to strengthen lifetime income. The key idea is to buy time for compounding while still managing sequence and longevity risks. Now let's test your understanding. Question: what is the biggest hidden cost of annuitizing a large lump sum immediately? Option A, higher fees than mutual funds. Option B, opportunity cost from lost compounding and market participation. Option C, taxes are always lower with annuities. Option D, inflation risk disappears with guarantees. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is opportunity cost from lost compounding and market participation. By turning on income immediately, you restrict the asset's ability to grow. Over long horizons, compounding is a primary driver of wealth, and giving it up can be very costly. Question: before buying an annuity, which item should you always demand? Option A, guaranteed 10% annual return. Option B, no surrender charges ever. Option C, full transparency on fees, riders, death benefits, and crediting rates. Option D, a promise that income will always beat inflation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is full transparency on fees, riders, death benefits, and crediting rates. Without this information, you cannot fairly compare annuity options to alternative strategies, and you risk misunderstandings that could be expensive later. To summarize the key points, remember that annuities are fundamentally income tools, not growth vehicles. Immediate payouts can function like a structured liquidation of principals, especially in early years. The largest hidden cost of immediate annuitization is the loss of compounding and market participation. Therefore, always demand full transparency on fees, riders, death benefits, and crediting rates. Finally, consider delaying or partially annuitizing while maintaining a growth sleeve to support long-term purchasing power. Next, we will close with a quick recap. In closing, immediate income guarantees provide psychological comfort, but can be financially costly over long horizons. Growth forgone today can translate into substantial missed wealth tomorrow. A balanced approach blends near-term income stability with long-term compounding through cash ladders, diversified portfolios, and possibly delayed annuitization. Always compare like-for-like illustrations and consult a fiduciary advisor. Finally, let's restate our disclaimer before we sign off. As a final reminder, this video is educational and not specific advice. Your financial situation is unique, and annuity contracts vary widely. Please seek personalized guidance from a qualified fiduciary advisor before making decisions. Thank you for watching. If you found this valuable, please like the video, share it with someone who is planning retirement, and subscribe for more evidence-based money insights. Post your thoughts and questions in the comments. What would you do with $400,000? Rush to guarantees or build in time to compound? I look forward to your ideas.